Hello, Dynamic Directions, and welcome to this edition of Bullish on Business. This is your host, Certified Master Coach John Randall. It's great to see all of you in this video series. We have some very exciting things from our investment guru, CAC and top advisor, Drew Watson. Drew's going to take us through his latest in what's going on in the markets and the world of investments and what you can be doing with your clients. Also, a very special deep dive in one of the most important areas for your largest clients, which is fixed income. You know, fixed income is certainly the path to the hearts of some of your largest and wealthiest clients and prospects. So Drew is an expert in this area. He has his information organized. He'll take you through what he's doing, what you can do for your clients, and how you can enhance what you do for your best clients, and also reel in some of your top prospects. So enjoy the information. We look forward to seeing you in upcoming coaching sessions and also seeing you at some upcoming D2 events. Everyone stay bullish, rock on, and we'll talk to you soon.
Hello, Dynamic Directions. It's been a month since we've been together, and I wanted to give you an update since the last time we've spoken. Specifically, I would say the big news is interest rates and crude oil. Rates have gone above 3% on the 10-year Treasury and have remained there, mainly bolstered by what I would call strong economic data that came out in the middle of May. Unlike some of the rate increases that we had from February to April, which were mainly based on the fear of a potential trade war, I would say these increases in interest rates have been more warranted based on hard, cold economic facts as opposed to irrational trade fears. With that said, we will get into in our next segment the best way to position for these types of rate environments. But basically, in looking forward, I think one of the things that has really strengthened in the last month and a half has been crude oil prices. As of the date of this taping, West Texas Intermediate's at about $72.45 a barrel. Brent crude is crushing over $80. Burns and I have really studied this, and it appears on the charts there's not a lot of resistance to stop oil prices from going up. It won't be a straight line, but I think definitely on West Texas crude, 80 to 85 bucks might be in the cards. But more importantly, I think what we're getting is a mix of geopolitical uncertainties, especially in the Middle East and other oil-producing countries, that will help sustain a bid under crude. According to BCA, probably the biggest unhedged oil producer might be Occidental. Chevron apparently does not have as much hedged as Exxon, so oil prices that are going up should be a tailwind there. Specifically speaking, I think a lot that has caused this run-up in prices has to do with Venezuela. About 9 months ago or so, BCA did an article about what they considered to be the risk to the oil prices that would help push them up. And that had to do with what's going on in Libya, Nigeria, Iran, Iraq, and Venezuela. Outside of the U.S., Saudi Arabia, and Russia, those are the next tier of top producers. As you could probably gather, they're nowhere you'd want to go on vacation. But the thesis of the article was in most of those countries, there has been almost no Western oil companies that have remained on site for any extended period of time, and thus for either 10 years, 20 years, maybe even longer, you've had no schedule of routine maintenance, shutdowns, or upgrades, and especially no real technological advances being brought on site in those countries. And it was just a matter of time that baling wire and duct tape would break down, and sure enough, that's what's going on in Venezuela. Venezuela production is probably down 1 million to 1.5 million barrels a day just in the last 6 months alone. And with the Iranian deal, with the U.S. pulling out of there, I would think the ability for Western oil companies to be involved in Iran would be greatly hampered. So not only does the charts and the technicals look favorable for higher oil prices, but I think the geopolitical boots on the ground view is that oil prices may continue to go up as well. What does this mean? Well, for one area that has just been beaten down for the last 2.5 to 3 years is the oil and gas transportation sector. Ben worked for one such company, pipeline stocks. It appears that once oil kind of crossed over $70, some new life was breathed into this sector, and we will see if the higher oil prices, which they should, leads to higher prices in the MLP sector. Another stock that has just been obliterated since our last call has been Altria Group. This is a symbol MO. It's in a lot of the models that are used, and for a long time it was a stalwart of some of the dividend growth models and dividend payout indexes and models even that IRG used. MO's down about 15 to 20% just in the last month alone. Historically, if you pull that up on the 20-year chart on your Thompson, you'll see anytime that the stock has had these kind of dips, if you've been patient, you've been rewarded. Now, there's always single stock risk when you look at this, but at these prices, the stock is paying over a 5% dividend yield. I think what's noticeable is if you go to the research page under the what used to be the old S&P research, you'll see they have a footnote that this stock has paid a dividend literally every year since for 90 years. So if you're a deep value shopper, you may want to check into that more closely. But as we kind of close on the market outlook, keep focusing on the international markets. The dollar has strengthened since our last call quite a bit. So any commodity priced in dollars that has gone up tells you there's probably even some more underlying strength there vis-a-vis look at crude oil. But the dollar has strengthened quite a bit, mainly because I think now people realize that the train has left the interest rate station for us, and that should continue, potentially to strengthen. That may put a little bit of weakness in other commodity prices besides oil. That's yet to be seen. But definitely a strong dollar could pose some difficulty for U.S.-based exporters. We will watch that as well as we will continue to watch what happens with emerging market currencies. Some of their debts may be priced in dollars, and it'd be more expensive for them to repay their dollar-denominated debt. So we will continue to watch those two factors and give you an update next month. Now a word from our sponsors. Welcome back, D2. Today's deep dive is going to be on fixed income. As we said at the top of the hour, interest rates have been moving up, and that has caused some of the more traditional bond investments to go negative year to date. And if you feel that rates will continue to move up, you probably are scratching your head to say, okay, where can we go for a little bit of protection in this type of market? I think first and foremost, don't outthink it. If you've got clients that want liquidity, want security, and have money they may need in the short term, we have piled in a lot of money into the short end 90-day U.S. Treasuries. As of the date of this meeting, the bid on those, bid yield is 192 to 193. And those are every 90 days, those mature. The 6-month Treasuries are now well over 2%. So for simple, hey, I want something safe, guaranteed, kind of set it and forget it, I would look at those really short-term Treasuries, and then as they mature and when the curve kind of steepens up, you can go longer with T-bills probably sometime early next year. The next place we've been putting a lot of money into is that Lord Abbett Inflation Protective Fund, LIFFX. It's held up very well in this market. I think everything that's gone on economically really puts a strong footing under inflation. Even kind of some of the irrational trade fears. As I explained to clients, if we were all sitting here and every stitch of clothing we had on had to be made in the U.S., it'd probably cost 3 times what it does now. And you can kind of see how inflationary the protectionist trade talk is. So that puts a bid in the inflation market. As well as you finally have kind of the biggest of all commodities market-wise, oil, hitting a bid as we discussed as well. All that information is inflationary. But probably most importantly, what's inflationary is the demographic situation here and the unemployment situation. I think you talk to your clients that own businesses, each one of you on the call owns their own business. It's getting more and more difficult to hire qualified people. The people that are qualified will be able to start naming their own price. All that is inflationary. So really explore that Lord Abbett fund if you want to. Other floating rate products we use a lot of the Eaton Vance floating rate. We've used a little bit of the index, but prefer to go to a real actively managed solution, especially in a lot of fixed income environments. Keep in mind, the bond indexes that are used in the ETF world are made up predominantly, instead of market cap, they're debt weighted. So the issuers, whoever issues the most debt, gets a higher weighting in those indexes. And especially if rates go up too much and the economy starts to slow down, that's the debt that's going to be most at risk. So keep that in mind for your Vanguardians and your indexers that come in, that when it comes to fixed income, that they may be better off going actively managed. That call just came in, actually, probably from the White House, President Trump wanting my opinion on how things might go. The final area to be a little bit worried of is if you're in any emerging market debt. As we stated before, dollar-denominated emerging market debt will get a little bit dicey, especially you have kind of the dual headwinds for these, not so stable countries of a stronger U.S. dollar, which makes it more expensive to pay the debt back, and rising rates in the U.S. So that would be an area, if you've ridden that tailwind for a while, to look at maybe curtailing your profits and moving elsewhere. The final product I'll highlight that we've used is the Mainstay Convertible Bond Fund, MCNVX. Take a look at this. The track record, I started using it when it was just an SMA account, probably 16, 18 years ago, has been pretty outstanding. It's been through some rate moves. It will act a little bit more like a dividend-paying stock, or actually a stock, to the downside if the market really crashes. But a lot of what it holds, specifically a lot of biotech stocks, still I think have a favorable environment where we are in the economic cycle. So that's what we're looking for fixed income. Start simple with the guaranteed treasuries, look at some inflation protection, look at floaters, look at maybe some convertibles, because I think the normal bonds are going to maybe get pummeled for a little bit as rates continue to go up. We'll talk to you next month and have a wonderful start to this summer. Thank you.